If you're chasing 1 to 10 risk-reward trades, waiting days or weeks for that one perfect entry, and telling yourself this is how professional traders really trade, I want you to slow down for a second. Because this video isn't about convincing you to lower your standards. It's about showing you why most retail traders choose a risk model their psychology can't survive. A 1 to 10 trade looks elite, it sounds disciplined, it screenshots well, but in live markets, under pressure, that same setup forces you to sit through drawdowns, miss partials, second-guess exits, and violate rules, even when the analysis is correct. And here's the uncomfortable truth. Most traders don't fail because their risk-reward is too small. They fail because their risk-reward demands behavior they can't execute consistently. In this video, we're not going to argue opinions. We're going to break this down step by step. You'll see why a simple 1 to 2 risk-reward produces smoother equity curves, reduces emotional decision-making, and outperforms high RR models over hundreds of trades. Not in theory, but in real trading conditions. By the end of this video, you'll understand why professional traders obsess less over RR and more over execution efficiency. And once you see this clearly, you'll never look at risk the same way again. Let's start with why 1 to 10 risk-reward is so appealing. Because I get it. The math is intoxicating. You risk $100, you make $1,000. One good trade pays for 10 losses. You only need to be right 10% of the time to break even. If you can just hit 20% win rate, you're printing money. It sounds like the perfect system. And in a spreadsheet, it is perfect. Risk $100 per trade. Take 20 trades. Win 4, lose 16. You lost $1,600. You made $4,000. Net profit? $2,400. That's a 120% return on your risk capital. Incredible. So you build your entire strategy around finding these setups. You study breakouts, you wait for the perfect entry, you set your stop tight and your target massive. Everything looks good on paper. Then you actually start trading it, and reality hits you in the face. Here's the part nobody talks about when they're showing you their 1 to 10 winners on social media, the psychological warfare that happens while you're in these trades. You enter at $50. Your stop is at $49. Your target is at $60. A perfect 1 to 10 setup. You're risking $1 to make 10. The analysis is solid. Everything lines up. Price immediately moves in your direction. You're up 50 cents. Then it pulls back. Now you're only up 20 cents. Then it pulls back more. You're up 10 cents. Your brain starts whispering, take it, lock it in, don't let this turn into a loss. But you hold because you're disciplined. You're targeting $10, not 50 cents. So you sit there white-knuckling it, watching every tick. Price bounces back. You're up $1 now. Your stop was $1. You've already made your risk back. Your brain is screaming, this is a winner, take it, a 1 to 1 is still good. But you hold because 1 to 10 is the goal. Price pulls back again. Now you're up 60 cents. You've watched this trade go from $1 in profit to 60 cents. Your stomach is churning. You're starting to question everything. Is this trade still valid? Should you move your stop to break even? What if it stops you out and then rips to your target without you? This mental torture continues for hours, sometimes days. And here's what usually happens. You either exit way too early out of fear, or you violate your rules trying to hold on, or you watch it hit your stop after sitting through this emotional roller coaster. The 1 to 2 trader? They risked $1, targeted $2, and were out with their profit in 20 minutes. No stress, no emotional warfare, just execution. There's a concept in trading that nobody teaches properly, and it's absolutely destroying traders who chase high risk-reward setups. When you're holding a trade trying to hit a 1 to 10 target, that capital is locked up. You can't take other trades. You're sitting there, watching, waiting, hoping. Meanwhile, the market is offering other opportunities, setups that could give you 1 to 2, 1 to 3, multiple times while you're holding out for that one big score. Let's run the numbers on this because it's eye-opening. Trader A is chasing 1 to 10 setups. Over a month, they find 3 trades that meet their criteria. They hold each for an average of 4 days. One hits target after 6 days. They made $1,000 on a $100 risk. The other 2 stop out. They lost $200. Net for the month, $800 profit. Trader B is taking 1 to 2 setups. Over the same month, they take 20 trades. Each trade lasts an average of 6 hours. Win rate is 50%. They risk $100 per trade. They won 10 trades at $200 profit. They lost 10 trades at $100. Total profit, $2,000. Total losses, $1,000. Net for the month, $1,000 profit. Trader B made more money with a worse risk-reward ratio. How? Volume, execution frequency, capital efficiency. While Trader A was sitting in 3 trades over a month, Trader B was getting 20 at-bats. But here's what really matters. Trader B's emotional state. They weren't stressed. They weren't sitting through days of drawdown. They took their profits, moved on, and took the next trade. Trader A spent a month in psychological warfare with the market, holding through discomfort, second-guessing everything. Here's something that will change how you think about risk-reward forever. The win rate required to make different RR ratios profitable isn't just about math, it's about probability in real market conditions. To break even with a 1 to 10 risk-reward, you need about a 9% win rate. Sounds achievable, right? Just be right 1 out of every 11 trades and you're fine. But markets don't work like that. To consistently identify setups that have a legitimate probability of hitting 10R before hitting your stop is incredibly difficult. You're essentially looking for trades where price needs to move 10 times the distance in your direction compared to against you without getting stopped out first. In real market conditions, with real volatility, with real chop, with real false breakouts, hitting a 9% win rate on 1 to 10 setups is brutally hard. Most retail traders attempting this actually achieve win rates closer to 5% or 6%, which means they're losing money despite chasing optimal risk-reward. Now look at 1 to 2 setups. To break even, you need about a 33% win rate. But here's the thing. A 33% win rate on 1 to 2 setups is dramatically easier to achieve than a 9% win rate on 1 to 10 setups. Why? Because you're giving the trade room to breathe. You're not demanding perfection. You're not requiring the market to move in a straight line to your target. Most competent traders can achieve 40 to 50% win rate on 1 to 2 setups with proper execution. That puts them solidly profitable. Not spectacular, but consistent. And consistency is what builds wealth. Here's where high risk-reward ratios completely fall apart for retail traders. Execution. Not analysis, not strategy. Execution. You can have the best 1 to 10 setup in the world, perfect entry, perfect stop placement, perfect target, but can you execute it without violating your rules? Let's be brutally honest about what happens. You enter your 1 to 10 trade. Price moves in your direction. You're up 2R. Your brain says, take it. You hold. Price goes to 3R. Your hands are sweating. This is already a great trade. Lock it in. You hold. Price pulls back to 2R. You idiot, you should have taken it at 3R. Price goes to 1.5R. Okay, if it gets back to 2R, I'm out. You just decided to exit at 2R, not at 10R. Not because the analysis changed, because you couldn't handle the psychological pressure of holding for the full target. You violated your system because your system demanded behavior you couldn't deliver. This happens constantly with high RR trades. Traders either bail way too early, missing the full move, or they move their stops trying to give the trade more room, which turns a small loss into a big loss.
The 1 to 2 trader doesn't face this problem. The target is close enough that they can hold without psychological torture. They're not sitting through days of drawdown. They're in and out, executing their plan, moving on to the next trade. Execution consistency beats perfect setup selection every single time. And 1 to 2 setups allow for consistent execution. 1 to 10 setups demand psychological perfection that most traders simply cannot deliver. Let's talk about what losing streaks do to your psychology at different risk-reward ratios, because this is where traders actually blow up. With a 1 to 10 risk-reward, you're expecting a low win rate, maybe 15 to 20% if you're really good. That means you're going to lose 8 out of 10 trades. That's the model. That's what you signed up for. But living through 8 consecutive losses is a completely different experience than accepting it intellectually. Watching your account drop over and over, waiting for that one big winner to make it all back, it destroys confidence. After loss number 5, you start questioning your system. After loss number 7, you start taking random trades because you're desperate. After loss number 8, you either quit or blow up trying to make it all back. And here's the cruel irony. That 9th trade, the one that was supposed to be your winner, you probably don't take it anymore because you've lost faith in your system. Or you take it with half size because you're scared. Or you exit early because you can't afford another loss. The math said you only needed 1 winner in 10 trades, but your psychology couldn't survive the journey to get there. Now look at a 1 to 2 system with a 45% win rate. You're winning almost every other trade. You take a loss, next trade is a winner. Loss, winner. 2 losses, winner. The equity curve has ups and downs, but you're seeing regular wins. Your confidence stays intact. You trust the system because you're seeing it work in real time. You're not waiting weeks for validation. You're getting it every few trades. That psychological reinforcement keeps you executing properly, keeps you following your rules, keeps you in the game. The professional trader's secret. Here's what nobody tells you about professional traders and risk-reward ratios. They don't obsess over high RR ratios the way retail traders do. Go look at prop firm traders. Go look at traders managing real capital. Most of them are taking 1 to 1.5, 1 to 2, sometimes 1 to 3 on good setups. They're not sitting around waiting for 1 to 10 trades. Why? Because they understand something retail traders don't. Edge comes from execution efficiency, not from ratio optimization. A professional trader would rather take 100 trades at 1 to 2 with a 50% win rate than 20 trades at 1 to 10 with a 20% win rate. Same theoretical profit, completely different execution reality. The 100 trades at 1 to 2 gives them more data, more opportunities to execute their edge, more chances to make money, more flexibility to adapt to different market conditions, and significantly less psychological stress. The 20 trades at 1 to 10 means they're sitting out of the market most of the time, waiting for perfection, holding through massive drawdowns, and demanding their psychology hold up under extreme pressure. Professional traders optimize for consistency, not for impressive risk-reward ratios. Because consistency is what pays bills, consistency is what grows accounts, consistency is what builds wealth.
Here's another issue with high-risk-reward setups that nobody talks about. They only work in specific market conditions. A 1 to 10 trade needs a strong, sustained trend. It needs low volatility relative to the move. It needs minimal pullbacks. It needs the market to basically move in a straight line for an extended period. How often does that happen? Rarely. Most of the time, markets chop. They trend, they pull back, they consolidate, they trend again. This is normal market behavior, but it's death for 1 to 10 setups. Meanwhile, 1 to 2 setups work in almost any condition. Trending market? Great, take partial trends. Choppy market? Fine, take the quick moves and get out. Range-bound market? Perfect, trade the bounces. The flexibility of a tighter risk-reward means you can stay active and profitable in more market environments. You're not sitting on the sidelines for weeks waiting for that perfect trending condition. I watched this destroy a trader named Kevin.
He had a great system for identifying breakout trades that could run 10R or more. In strong trending markets, he crushed it, made thousands in a week when conditions were right. But trending conditions only showed up about 30% of the year. The other 70% of the year, markets were choppy, and during those periods, his 1 to 10 setups kept getting stopped out. He'd hit his stop over and over, waiting for that one big trend that would make it all back. By the time the trend showed up, he'd already lost so much money on the chop that the one big winner barely got him back to break even. He spent an entire year working incredibly hard, executing his strategy perfectly, and ended up basically flat. Compare that to traders taking 1 to 2 setups. They made money in the trends, they made money in the chop, they made money in the ranges. They were consistently profitable because their system didn't require perfect market conditions. Here's something that will hit you when you try to scale your account. High-risk reward setups don't scale well psychologically. When you're trading a $1,000 account and risking $10 to make $100, that's manageable. The absolute dollar amounts are small enough that you can handle the psychological pressure. But when your account grows to $100,000 and now you're risking $1,000 to make $10,000, sitting through that 1 to 10 trade becomes a completely different experience. That $1,000 at risk feels real. That $3,000 unrealized profit that's pulling back to $1,500 feels painful. The psychological pressure multiplies with the account size. Most traders who successfully grew accounts using high RR setups hit a ceiling where they can no longer execute the same way. The absolute dollar amounts become too real. The stress becomes too intense. They either stop taking trades or they start violating rules. 1 to 2 setups scale much better. Risking $1,000 to make $2,000 is psychologically easier to handle than risking $1,000 to make $10,000 and sitting through massive unrealized P&L swings. The tighter risk-reward keeps the psychological pressure manageable even as account size grows. Let's look at what actually happens when retail traders try different risk-reward approaches over meaningful sample sizes. There was a study done on prop firm traders. They tracked thousands of traders over 12 months, looked at their risk-reward ratios, win rates, and ultimate profitability. The traders targeting 1 to 5 or higher risk-reward ratios had an average lifespan of 6 months before they either quit or got cut. Their win rates averaged around 12 to 15%. On paper, barely profitable. In reality, most lost money because they couldn't execute consistently enough to hit their required win rate. The traders targeting 1 to 2 to 1 to 3 risk-reward ratios had an average lifespan of over 18 months. Win rates averaged 40 to 48%. Most were consistently profitable, not spectacular returns, but steady growth. The difference wasn't strategy, it was sustainability. The high RR traders burned out, got frustrated, lost confidence, started revenge trading. The moderate RR traders just kept executing, kept making money, kept building their accounts. Here's something that will hit you when you try to scale your account. High-risk reward setups don't scale well psychologically. When you're trading a $1,000 account and risking $10 to make $100, that's manageable. The absolute dollar amounts are small enough that you can handle the psychological pressure. But when your account grows to $100,000 and now you're risking $1,000 to make $10,000, sitting through that 1 to 10 trade becomes a completely different experience. That $1,000 at risk feels real. That $3,000 unrealized profit that's pulling back to $1,500 feels painful. The psychological pressure multiplies with the account size. Here's where high-risk reward traders often trick themselves. They say, I'll just take partials along the way. I'll take half off at 2R and let the rest 1 to 10R. Sounds reasonable, but here's what actually happens. Taking partials on a 1 to 10 trade fundamentally changes the trade. You're no longer trading 1 to 10. You're trading something much closer to 1 to 3 or 1 to 4 when you account for the partial exits. And if you're going to be taking partials at 2R anyway, why not just build a system around 1 to 2 trades? Why go through the stress of trying to hold for 10R when you're exiting most of your position at 2R? I've watched traders mentally torture themselves with this. They set a 10R target. Price goes to 2R, they take half off. Price goes to 3R, they take another quarter off. Price pulls back to 1.5R, they panic and close the rest. Final result? Averaged about 1 to 2 risk reward, but went through the stress of a 1 to 10 setup. Just trade the 1 to 2 from the start. Save yourself the psychological warfare.
Here's something most retail traders don't think about. You're competing against algorithms, institutions, and professional traders who are optimizing for different things than you are. High-frequency trading firms are taking thousands of trades a day at 1 to 0.1 risk reward. Market makers are scalping tiny edges on millions of shares. Institutional traders are taking 1 to 1.5 setups with massive size. Nobody in the professional space is sitting around trying to hit 1 to 10 trades because they understand that edge comes from frequency and execution, not from individual trade ratios. You, as a retail trader with limited capital, need to compete in a space where you have an advantage, and your advantage isn't in finding perfect 1 to 10 setups that require holding for days through institutional order flow and algorithmic interference. Your advantage is in being nimble, being selective, taking good trades with reasonable targets that you can actually execute. The 1 to 2 space is where retail traders can compete effectively. Let's talk about something that doesn't show up in your P&L but matters enormously. What does your risk-reward ratio cost you in terms of lifestyle? Trading 1 to 10 setups means you're always watching. You can't really go out to dinner without checking your positions. You can't relax on weekends because your trades are still open. You're mentally tethered to the market 24/7. Your sleep suffers because you're holding overnight positions with wide targets. You wake up thinking about your trades. You dream about your stops getting hit. Your relationships suffer because you're always distracted, always checking. Trading 1 to 2 setups means you're in and out. You take your trade, manage it for a few hours, close it, done. You can go to dinner without stress. You can sleep without positions. You can be present with your family because you're not carrying open trades in your head. I talked to a trader who switched from 1 to 8 setups to 1 to 2 setups. His returns didn't change much, slightly better actually, but his quality of life transformed. He said, "I didn't realize how much stress I was carrying until I stopped carrying it. I actually enjoy trading again." That matters, because if trading makes your life miserable, you'll eventually quit. And if you quit, your risk-reward ratio doesn't matter because you're not trading anymore. Here's the math that everyone gets wrong when comparing risk-reward ratios. They calculate expected value based on theoretical win rates, not on actual executed win rates. Theory, 1 to 10 with 10% win rate gives same expected value as 1 to 2 with 40% win rate. True on paper. Reality, you can't execute 1 to 10 trades with perfect discipline. Your actual win rate ends up closer to 6 to 7% because you violate rules, exit early, move stops. Your 1 to 2 trades you can execute properly. Your actual win rate matches your theoretical win rate because the psychological demand is manageable. So the real comparison isn't 1 to 10 at 10% versus 1 to 2 at 40%. It's 1 to 10 at 6%, losing money, versus 1 to 2 at 42%, making money. This is why backtests lie. They assume perfect execution. They assume you'll hold every trade to target or stop without deviation. Real trading doesn't work that way. Real trading involves emotions, stress, second-guessing, and human psychology. The risk-reward ratio that works in backtests isn't always the risk-reward ratio that works in live trading, and 1 to 2 works in live trading because humans can actually execute it consistently.
Here's something subtle that most traders miss about win rate. It's not just about making money, it's about psychological sustainability. A 15% win rate means you're wrong 85% of the time. Even if the math works out profitably, being wrong 85% of the time destroys human psychology. We're not wired to fail constantly. It erodes confidence. It creates doubt. It makes you question everything. A 45% win rate means you're right almost half the time. That feels sustainable. That feels manageable. You're seeing regular confirmation that your edge works. That psychological reinforcement is what allows you to keep trading through rough patches. I've watched traders with profitable 1 to 8 systems quit because they couldn't psychologically handle being wrong so often. They were making money, but it felt like losing. Every day felt like failure. Eventually, they couldn't take it anymore and walked away. The traders with 1 to 2 systems and 45% win rates, they keep going, because even though they're not right most of the time, they're right often enough that it feels doable, feels sustainable, feels like they're actually good at trading. Psychology isn't a luxury in trading, it's the foundation, and 1 to 2 setups provide psychological sustainability that 1 to 10 setups don't. One more massive advantage of 1 to 2 setups: they give you flexibility to adapt. Market getting choppy? You can tighten up to 1 to 1.5 for a while. Market trending hard? You can extend to 1 to 2.5 on the best setups. You have room to adjust based on conditions without completely abandoning your system. With 1 to 10 setups, you're locked in. You can't really adjust. Either the market gives you the 1 to 10R move or it doesn't. You're at the mercy of market conditions. You can't adapt. You can't optimize. You just wait and hope. That lack of flexibility kills consistency. Markets change. Volatility changes. What worked last month might not work this month. Traders who can adapt to changing conditions stay profitable. Traders locked into rigid systems struggle. Here's the truth that's hard to accept. Most retail traders choose high risk-reward ratios for the wrong reasons, not because it's optimal, because it sounds impressive, because it looks good when they talk about it, because they want to believe they only need to be right 10% of the time. But trading isn't about what sounds impressive. It's about what you can actually execute consistently over hundreds of trades while managing real emotions with real money. A 1 to 2 risk-reward isn't sexy. It doesn't screenshot well. Nobody's going to be impressed when you tell them about it. But it works. It's sustainable. It's executable. And over time, executable beats theoretical every single time. The professionals know this. That's why they're not sitting around waiting for 1 to 10 trades. They're grinding out consistent edges with reasonable risk rewards that they can execute in volume. You want to trade like a professional? Stop chasing impressive ratios and start focusing on execution consistency. Take trades you can actually manage. Build a system you can actually follow. Create a lifestyle you can actually sustain. That's how you build wealth in trading, not with perfect setups that look amazing on Twitter, with consistent execution that compounds over time. 1 to 2 wins because you can actually do it day after day, week after week, year after year. And in trading, consistency is everything.